Yes, sir. What's up, dude?
What's up, man? How are you?
I'm great, man. Really quick, could you smile for a thumbnail for me? Just like a quick.
Yeah, there you go.
Sick, dude. Um, Mr.
Sweet.
Felix, thanks for coming on, man. How are you?
Good, man. Yeah, happy to do this. Excited.
Yeah, I'm a big fan. I think it's gonna be a fun one because we definitely have some audience crossover, but I would say that threadguy viewers skews heavily into Sol on chain versus
Yeah, cool.
versus macro listeners. I mean, I guess to start, like it was a crazy fucking weekend. I didn't stream Friday, but the whole week last week was nuts. I mean, can you just give me a take on why Bitcoin is at all-time highs and surging right now?
Yeah, so for those that don't know me, I focus pretty heavily on the macro world. That's sort of how I got into crypto. So I view everything through a macro lens. I run my own macro podcast over at Blockworks called Forward Guidance. And so I'm always looking at things through that macro lens first, and then, sort of run like a barbell world of being, doing some macro trades and then super in the trenches on chain, everything in crypto kind of follow. So yeah, my framework for while we're at all-time highs is just thinking about where we've been over the last few years, which is, traditionally, if you start to get into macro, you think, okay, we're at high interest rates. Generally speaking, that's not great for growth. That's not great for risk assets. So we're probably going to go down. And it feels like, a lot of people got that mixed up in 2022, and we started to see interest rates get jacked up a bunch, and we started to see Bitcoin do pretty well. And the reason for that is because we live in an era of fiscal dominance. We live in an era where we see fiscal deficits as a percentage of GDP are at like 7%, which that's basically normally what we see during a recession. So we have an economy growing and we're running a fiscal deficit that we'd be running during a recession. So of course, things are going to do exceptionally well. So we're in this world now where you have that, and then you have this tariff dynamic happening right now. And the second order effects of tariffs are really nuanced, because we're getting into this regime now where, over the last 20 years, a lot of capital has gone into US assets, right? This is basically, I won't get too deep into the math, but when you have a trade deficit, goods come in from the rest of the world into the US, and then dollars go out to the rest of the world. And that's the other side of the equation, which is the capital account. So for decades now, we've seen basically these capital flows get recycled into US assets. And then now when you have Trump bring forth all these tariffs, that starts to reset a lot of these institutional capital flows that have been going on for so many decades. You have to start to rethink, where is your risk at, and do I have like the right amount of risk premium associated with those? So I think this is why we're starting to see hedging in terms of a diversification of what these big capital allocators own, instead of just being all in on US assets like, NASDAQ and like NVIDIA and that sort of thing. They're starting to think about owning more gold. And then, further down the risk curve, they're starting to think about owning more Bitcoin. So we've seen that a lot of the money that's been coming in is this capital institutional money. It's not, the retail that we're selling in 2021. So as long as we start to see these tariffs continue and these changes in these capital flows, I think it's just going to continue. And as long as we see these huge fiscal deficits, I think it's going to continue as well. I think people overemphasize the impact of the Fed these days in monetary policy and like where interest rates go, and they underestimate that dynamic. So yeah, that's where we're at. And, so I just can't see any reason to be structurally bearish until that changes.
You've kind of nailed this entire move, haven't you? I remember you posted that article a couple months back on Bitcoin.
Yeah.
Like, have you just fucking printed the last like 3 months?
Yeah, it's been a great few months. Yeah, I wrote this piece in mid-April, which basically started to articulate this theory that I had, that Bitcoin is going to be the fastest horse out of that April crash. So back then, everything was nuking, people were freaking out, and I just had this belief that this was Bitcoin's moment to shine, and therefore crypto market as a whole as well, because it's all correlated to it. Because yeah, again, this diversification into it, and the fact that you can't tariff Bitcoin. You can put on capital controls on like US equities, but you can't tariff Bitcoin. It sounds so simple, but it's such a powerful thought. So it's been a good few months. I think it's just getting started.
It's just getting started. Hey, was that was that the article where Giver replied and was like, called you retarded? It was like great article. Like, I mostly disagree with everything. Yeah. Was it that one?
Yeah. No shade, but yeah, it was that one, and it's turned out well. I took a little bit off. I always try to harp on people about risk management in these things, because it feels like so much of crypto Twitter is either like full bear or full bull, and it's like either I sell everything or I buy everything. So like the way I thought about it is that, all right, I loaded up the truck at like 78 to 82K, and I took some off in the low hundreds. The reason I did that is I thought we were still going to go higher, but by taking a chunk off mentally, I know that I can hold what I have for a lot longer because I know that I've already, taken some chips off the table. My thesis is looking good, and now I can let the rest run. So now I'm not touching anything. I'm just letting it all run.
Yeah, well done. And documenting in public is
Thanks,
hard.
man.
Can you? I guess,
Yeah, it is.
Yeah, it's fucking hard. I guess to follow up on some of the Bitcoin stuff, can you explain like who is the marginal buyer here at 120K and how far are they realistically going to be able to drive price?
Yeah, so the big one right now is these treasury companies that just seem like they're just, a new one pops up every day right now.
Yeah.
And it's an interesting one. So trying to figure out. I've been trying to figure out who the marginal buyer is, and I think it's a lot of retail. It's a lot of folks the ones that were buying like, the ARC in 2021 and that sort of speculative money. So there's a lot of that for sure. Traditionally, these treasury companies, it was capital that couldn't custody, say, Bitcoin directly, but they could own it through an equity. And this is at the time where we didn't have ETFs yet. So that was like the whole MicroStrategy play, is that big capital that couldn't actually own and custody yet was buying these ETFs, or no, sorry, not these ETFs, these treasury companies as a means to get access. Now what we've seen is this has moved forward into, obviously we have ETFs now, but every single of these companies, or most of them, trade at a multiple of net asset value. So they're buying, say if it's at like a 1.3 MNAV, right? They're buying at a significant premium to where the spot's trading at. So it basically becomes a leveraged bet on Bitcoin. So it's people, I feel like it's sort of becoming like the altcoins for the either institutional or the Bitcoin maxi space. So that's been a big marginal buyer. Then there's also just like registered investment advisors. So when you look at Bitcoin ETFs, when they first launched, a lot of the money that was coming in first was a lot of fast money. So it's people like Jane Street and these like multi-strat hedge funds a lot of them are just doing like, say, basis trades or coming in and out. So basis trade where, you just basically own the spot and short the CME futures, and you can basically make a spread on the carry. So it's delta neutral. So really they were mercenary capital. But what we've seen in the last few months is that started to change. If you look at the top holdings of Bitcoin ETFs, it's all RIAs. So it's all just like regular people that just want to own, 2 to 5% in their portfolio. And yeah, it's very durable. There was concerns originally that sort of money would be, a little panicky when we start to see some drawdowns. We're not used to that volatility. And I think we've seen the opposite. They've been holding it fine. They sized in well. It's a different story when you're buying half or your entire net worth versus 5%. So yeah, it's been a bit of everything.
Do you start to get a little bit nervous on the treasury company meta when you start to see all these ETH treasury companies pop up and now there's hyper liquid treasury companies popping up? Like, does that sort of change the equation long term a little bit?
Yeah, big time. So the way I think about it is that we're in this stage right now where it feels like there's just unlimited supply of these treasury companies. Like everybody's launching one, but there's only a certain amount of capital in this space, right? So this game works as long as they all remain at a premium to their NAV because they can issue equity and not dilute shareholders. It's kind of their fiduciary duty is basically to do that because they're at a premium. So why not capture it for equity investors? The issue that I'm concerned at, and I'm not saying that this is the issue today. It's sort of the opposite right now. Like we're seeing the premium, the NAV accelerate, but the issue that happens is if we start to see a discount to NAV. In that situation, you sort of have to, and remember, like I say the fiduciary obligation because this is really important, is that board of directors have to operate in a way that is accretive for shareholders, like they're legally obliged to. So if you get into a situation where you have a discount to NAV, it starts to be like a few different second order effects of them having to think about how to deal with that situation. So one of them, for example, could be that they would have to actually sell the underlying asset that's trading at a discount to buy back shares effectively. So that's a pretty weird one where say you have, like an ETH treasury company or Bitcoin treasury company. I'm not going to discriminate. They're all at the whim of this, but they could easily either like sell their underlying to buy back the shares. So it'd be pretty bad for the underlying. Like if you're long Bitcoin, that sucks. But the equity holders could do okay. And then at the same time, like you could have event-driven funds that come in and just basically try to take like a majority ownership of these companies, earn the spread, and then just widen down the company. But they would do that by selling the underlying asset and capturing the spread. So this is what I think will eventually cause like the next unwind whenever this bull market ends. But there's really no signs of that ending right now. So it's sort of like keep dancing while the music's playing, but keep keep a good look on where those premiums are at.
Can you explain like the dumbed down version of why these treasury companies are trading at a premium to NAV? Like,
Just speculation. I really think there's not much more than that. Like, originally the argument for like when it was just MicroStrategy was that was basically the premium you had to pay to get exposure, because you couldn't get institutional exposure anywhere else without having to have these custody risks. So it's kind of like the cost of doing business. But now we're in the situation where they're sort of ever present across all of them basically, and they're quite durable. So yeah, I think it's literally just demand. I don't want to go as far as saying it's like a Ponzi scheme or anything, but really it's just this constant cycle of like new capital coming in to keep the premium elevated, to pay off those that came in earlier, and keep that afloat. So there's nothing like durably sustainable about keeping it above that, other than just demand appetite, honestly.
okay. Okay, so to move to a little bit of a different topic that I also don't understand the third order effects of. What does a potential Powell resignation mean for the market? And do you think that's going to happen?
Okay, so I'd probably put it at... So Powell getting fired, I'd probably put it at about 5% odds.
Okay.
Powell resigning, I'd probably put at like 10 to 15% odds. And okay, so if he gets... I got to think about this in two tracks here. So if he got fired, the first reaction that would happen is that capital would flow out of the US very significantly, and they would be selling US Treasury bonds. So you'd probably see you'd see bonds sell off. And the second and third order impacts of that, I think, would be that you would get US equities would go to shit. And with that, you would probably see the correlation from Bitcoin and crypto go down as well on that. It would be really, really bad. I think people that get almost excited about this idea haven't thought through this. Like, we've had these moments in macro. We've been calling it lately like the Liz Truss moment, because what happened a couple of years ago in England is that the new prime minister in England, Liz Truss, put forth a bill that was just going to blow out the deficit, and it was going to be entirely unfunded. And basically what happened is, over a few days, the long end of the bond market started to sell off so aggressively that she resigned as prime minister after like, I don't know, a couple weeks. And they had to actually do QE for a couple months in England, because that's how bad it got. So there's a lot of talk these days in the macro world about what would it look like for like a Liz Truss moment in the US. And I think firing Powell would be a Liz Truss style moment. Like, you would lose the bond market. So that's concerning. If he resigned, I would probably dial back that potential quite significantly. I don't think it would be great for the bond market, but you might be able to see risk assets look through it. But it would be really bad. You'd see the US dollar go down a lot too. It's not something that you want as a bull.
Whoa. So basically, either way, Powell out is not good for markets.
Yeah, exactly. Because it loses the bond market, and then like when you lose that long end, everything else is sort of anchored to it. Like it's the bedrock. The US 10-year is the bedrock of the financial system in many ways. So when that goes, kind of everything else goes as well. This is what happened in like March 2020. The crash got really bad when the treasury market started to seize up, and that's when they came in with like QE infinity and all these things.
So you mentioned QE, which I know is like a running joke for you on Twitter.
Yeah.
Can you give me like the super high level, like max dumbed down version of like what QE is, and then what market conditions would have to look like for QE to be implemented, and then sort of like the effects it would have on the market, and if it's going to happen.
Yeah, sure. Yeah. All right. So quantitative easing is when the central bank goes into the secondary market of the treasury market, where these long end bonds that we're talking about get traded each and every day. So typically the Fed only works in the short end of the market, like the Fed funds rate. When you hear about the Fed changing interest rates, it's that short rate. It's the overnight rate. When they're actively participating in the long end, they're doing a swap, which is what quantitative easing is. So what happens is they go into the secondary market and they buy treasuries from primary dealers, which are just big banks, like think JP Morgan. So they'll buy treasury bonds from JP Morgan, and then they'll give that primary dealer central bank reserves. And what happens from that is it starts to get a little wonky, starting into this world of like term premium. But effectively what happens is the theory is that it brings down rates on the long end. It brings down the yield on it. And when you bring down the yield, and when you take out what fixed income people call duration, When you take the duration out of the market, basically that starts to push people further out the risk curve. So now suddenly all the people that were trying to buy treasury bonds and that are starved for yield, they have to go to, say, commercial paper like corporate debt. And then the people that are trading corporate debt start to get crowded out. So they go out and buy equities. And then the people that are crowded out in equities go out and buy Bitcoin or something like that. So it's this cascade. It's highly psychological, honestly. Like the biggest impact of it is psychological. So the big argument is whether that's money printing or not. And honestly, like there's PhD economists that debate this, whether QE is money printing. Because like I said, it's a swap. It's taking a bond and it's swapping it with a central bank reserve. So it's up for debate. All that you need to know is that it is bullish for markets. It takes duration out, which it really elevates risk assets. Now, the magic of it is that it does this because it's a swap and because central bank reserves cannot be put forth into the broad economy. They can only be traded between these primary dealers, so only between the banks. So in a way, it's a way to like lift up financial assets without it going into like Main Street inflation, which is why it worked for so many years. Now, the reason it stopped working is actually because in 2020, we started to give out stimmy checks, right? We started to just fully give out money, helicopter money, just throwing it at people. And that's super inflationary. That is insanely inflationary. So that's basically the lay of land. Now, what would need to happen for us to get QE again? If you listen to the FO, if you listen to Jay Powell, if you listen to the Fed, we would need to get rates down to zero and then have them be like, oh shit, that's not enough. The economy's still tanking. We need to do QE. So they have never done outright QE when rates are above zero. So that's sort of the first mandatory that needs to happen. Now, people will look at like the Fed balance sheet and be like, oh, well, look, there's been times, say in 2019, where we've seen them provide liquidity, quote unquote, even though rates weren't at zero. And that's, getting too deep into semantics, but basically like they weren't buying long end treasuries. They're buying stuff on the short end of the curve. It's not quite the same. So all I would say is that like if you're somebody that's hoping for QE and you're a bull, you probably don't want that because it means that we got rates all the way down to zero and that wasn't enough.
And it still
and
wasn't
markets
enough.
are still crashing.
Damn.
So yeah, it's not really something to really fully hope out for. And so the last thing I'll say too is that I think people are so, it's like the Pavlovian dog response at this point about QE, right? Where they want the QE because it makes their bags go up. And I would say is that honestly, in my opinion these days, a 7% of GDP fiscal deficit is more powerful than QE. When you have an important conditional reason for that is that when you have these high rates, you have the interest income going to people that own like money market funds. But those people, if they're in a mortgage that they got at 2% in 2021, or if they're like a big corporation that turned out their debt in 2021, their liabilities are fixed. And even if they hike up rates a bunch, it doesn't matter. But then their interest income increases. So if you have that dynamic happening with a huge fiscal deficit, I think that's more powerful than QE. So I think that's a big reason why like Bitcoin's where it is at right now, which confuses people that think crypto's only like a QE phenomenon, basically.
Damn. Are you like do you have like econ professor in your future here? Like what's the deal?
Yeah, I studied business. I didn't do all the CFA. I did the level 1. And I'm just super passionate about macro for sure. Like, but honestly, there's so much of this, like you can't learn. Like if you go and study macroeconomics at the undergrad level or something, like you don't get the into weeds details of how markets really work. Honestly, it's just about showing up every day and learning and iterating. And so, oftentimes I have people ask me like, how do I learn everything or like, how do I learn about macro? And literally it's just showing up every day, seeing things happen and then digging in to figure out why is this happening and how does it work? And you rinse and repeat that every day and eventually you get there.
Here's one for you is like, if you are primarily an on-chain crypto trader, and that's the majority of the trading activity that you do, what are the only key macro indicators you need to pay attention to know if we're risk on, risk off? Like assuming you're not going to be super in the weeds, you don't know everything that's going on. Like what are like the key things you have to pay attention to?
So the most important one is that fiscal deficit as a percentage of GDP. You can look this up. And this is so key. This is why back in January, February, I got pretty bearish. And it's the big reason for that was because there was talk about even balancing the budget. If we got a balanced budget in the US, markets would crater, like absolutely crater. So the biggest thing is looking at that fiscal deficit. Now, the quote unquote good news is that with the big beautiful bill passed, we're actually going to be going from like a 7% of GDP fiscal deficit to like 8%. So that potential outcome that they were talking about in February is definitely not happening anymore. We're on the other side of like the bell curve at this point, looking at running it hot. Now there's some debate around like, will tariff revenue actually offset some of that? It's up for debate, but that's the biggest one. Honestly, in the regime we're in, just keep a track of where the fiscal deficit is at. If it's where it's at and if it's accelerating like it's looking like it's about to, you're probably on the right side of history in terms of being bullish. I would say the other one is there's this whole like global liquidity thing, which is I feel like it's another one that's become a running joke with me because people, I don't know, people think I hate it. I don't hate it. I think it's pretty accurate. What I hate is when people think that like, the whole like you have M2
The
money
M2
supply
Bitcoin
or whatever.
chart. Yeah.
Yeah, exactly. Yeah, the M2 one. And it's a useful metric, but it's not the Bible, It's not going to be tick for tick 100% accurate. And that's my only issue is when people think it's like, oh, look, in 48 hours Bitcoin's going to go up 3.48% because the money supply says so. It's another one that just look if it's on the right side of things right now. And so that's growing. So obviously that is positive. So I'm not going to say just fully dismiss it. So those would be probably the two big ones. I would say you don't need to overweight as much monetary policy and like where rates are going as much in this regime. Those two things are a lot more important. So I would underrate the importance of rate cuts and overweight those two. I think they're way more important.
The M2 Bitcoin chart, that's the Raoul Powell special, isn't it?
Yeah. Exactly.
You just had him on. I haven't got to listen to it yet,
yeah.
but I'm excited for that one.
Yeah, it's good. And they've been killing it. Like they got bullish at the bottom in April with me, and they've been nailing it as well. So, it's just like, what's the saying? Like, all models are wrong, some are useful. So, it's as long as you have these things that keep you on the right side, but always like remembering that markets are dynamic and it's all about like probabilities, I think that will keep you in a good spot.
It's kind of like a brutal question, I guess, but where do you think we are time-wise in the cycle?
So two things. One, I don't do price targets. I have no idea price-wise where we go. Just to set that there. I focus really closely on like momentum. There's a million ways you can do that. Like I use pretty closely like crossovers and moving averages to basically, my whole thing is like I get inflection points really good, like I did in April in terms of like macro inflection points. But sometimes I'll sell too early, or it's like how much juice is left in this move. So for me, just overlaying something like a momentum factor keeps me in the right side of the trade. So for me, it's about just keeping a track on that like high level momentum. And yeah, in terms of when I think about, I don't know, the next 12 months or so in terms of the macro picture, I think it's still got a lot of runway. If I think about like a classic halving cycle type thing, I mean, I don't really remember where we're at in terms of that. Probably like, I don't know, like what, 6 months left to that based on if you like follow like a classic halving chart or something. So, I mean, that's a decent analog, but I think following 4-year cycle halving cycles are basically dead now. Like at this point, each halving, it's the law of diminishing returns, right? The amount of Bitcoin that gets cut in half in terms of issuance is just smaller and smaller. So I think this was the last one where it was somewhat relevant, and I think moving forward it's just way less relevant. And I think more so it's going to be about like institutional capital risk appetite more than anything. Like so much of the reason the 4-year cycle worked for so long is because it was all crypto natives that were like attached to it, and then like VC fundraising cycles are basically attached to it too, right? So like when they launch and when they get unlocked and all of that, it sort of all started to commingle together. So yeah, I don't know. I feel like to me, 6 months definitely have a lot of runway. 12 months, I don't know. We'll see.
I like to hear that. Okay, I guess one of the last things I want to ask you, because I won't keep you. I'll try to cut you at 30. Is what's your take on, like, generally speaking, like DeFi overtaking TradFi, and how does, like, what's like the sentiment in TradFi right now? How have everything that's happening with stablecoins, equities on chain, like where is this going, and how aggressive is it going to be?
Yeah, so I'm a huge stablecoin bull. The way I think about them is basically them being a new digital version of money market funds. So money market funds were something that was in the US where people could put their cash in there and get a yield that was effectively the same as like a T-bill yield, basically. So, right now that'd be like 4.5%. Now the issue is that stablecoins, if the Genius Act passes, they won't pass on that yield. Basically they keep it. That's the whole issue. Like USDC and USDT aren't interest bearing, but it's a good framework to think about, and I think it will unlock a lot of foreign capital demand for US dollars. So I'm very excited about stablecoins, and I think the reason the Trump administration is very excited about stablecoins is because they're going to be a pretty significant buyer of like US debt and demand for US dollar. And I think it'll further increase the US reserve currency hegemony over the next 5 to 10 years. So I think that's really powerful. I mean, that's everything every bank is talking about right now. So that one I'm super positive on. The lending space, like the DeFi lending space, is an interesting one. I actually interviewed Sid from Maple on my show a few weeks ago, and we were chatting about like what they're doing, because they walk this interesting line between having like non-permissionless, like custody, full DD lending for institutional capital, but then they also have like the permissionless side of things, like through the syrup tokens. So they're kind of walking these two lines where you have, the big institutional money, you have somebody like a real human you're actually talking to. You're not just like working in a protocol permissionlessly. So I feel like that they're at a really interesting balance point between the two. Like some of these big money flows, they still want to be able to talk to somebody who can actually like vet them for credit risk appropriately and not just like rely on over collateralized like DeFi lending protocols. So I think that world's going to increase a lot, and I think the main reason it'll increase a lot is because you have a better line of sight into your counterparty, so lower counterparty risk, as opposed to like some of these OTC lending stuff in the TradFi world. You barely know who your counterparty is and what their risk exposure is. So I think that's a super powerful unlock. And in the same vein, I think capital efficiency through like settlement and rehypothecation is going to increase a lot too. So I think those two vectors are going to make TradFi really excited about it. And then the last one, like just like on-chain equities, I think it's really interesting. I think obviously the popular thing is being able to trade like Mag 7 on-chain. And I think that's mostly interesting for people that don't have access to US equities, like in other countries. So it's all well and good for them. I think what I'm most excited about is the opportunity to take that like perp format and apply it to things like FX currencies and commodities and like more liquid things. I think that's what's really interesting to me. And it sounds like that there's a lot of like pretty smart people building towards that. So yeah, those are kind of the main three I'm interested in.
Do you ever feel like you know too much and it hinders your ability to like turn your brain off and just smash by?
I'm gonna take that as a compliment, but yeah, sometimes. But I'm also honestly, I think people misunderstand me about like how I can just be like a left curve degen that'll just smash by sometimes. Like in 2021, I was like trading NFTs a lot, and there,
You were
you're just
tweeting
like
about
you have
that.
30.
I didn't know that, Laura. I saw you
Yeah,
tweeting
yeah.
about that. Yeah.
Oh yeah, dude. Like before the whitelist meta, like when you could just mint anything, I was just, and you have 20 seconds to decide whether to mint, right? So you're just like, all right, hit it. So yeah, I feel like I know when to turn my brain off, but it's all about sizing for me. Like I'm not going to be doing that with 70% of my portfolio. Like I only ever keep like, I don't know, 5% of my net worth on chain. And that's just like pure speculation to try to run up. And then, if I do well, take it off and make it real. So I think I can turn my brain off because I size appropriately. But yeah, it can definitely be a hindrance. Like you see the curse of the mid curve hitting people sometimes.
It was a compliment, by the way. Our actual last
Thanks,
question.
man.
Actual last question. What percent of your net worth right now is in the market? All markets.
Oh man, probably like 80.
Oh fuck yeah.
Yeah.
Okay.
Yeah. Yeah. Pretty much all along. So I very rarely short. I'm either I'm either in cash or long. I really rarely short. But I like to own assets that have sort of a negative correlation to other ones. So like if you're super long Bitcoin or something, like you can own, say, bonds if you're worried about growth slowing down, or you can own gold if you're worried about interest rate hikes and inflation and that sort of thing. So for me, it's about diversification, allowing me to have less cash and be more long, basically. And then, if things get sketchy, I'll just raise more cash. But for me to short, it takes a lot. It's really hard to short, man. Like it's I don't think it's worth it for most people.
Most retarded bull makes more than the smartest bear.
Exactly.
Dude, this was
Always.
sick. Is there anything you want to show before you go?
Yeah, I mean, like I said at the top of the show, I host the Forward Guidance podcast on the Blockworks Network. Interview people every week, macro people, some crypto people, more and more every day. Those worlds are colliding, so there's a lot of intersections. Do a weekly roundup as well where we talk about macro, get in the weeds. So yeah, if you're interested in learning about macro from people that trade crypto pretty heavily and kind of get the culture, it's a good place to be. But yeah, man, appreciate you inviting me, and I appreciate it.